Most people moving into retirement are terrified of two things. One, losing half their nest egg in a market crash, and two, running out of money before they run out of time. You have likely been told that you have to choose between the safety of savings accounts that pay nothing or the volatility of a stock market that keeps you up at night. There's a way to capture the upside of the stock market without ever seeing your account balance drop when the index goes red. I'm Ron Bristol with Advanced Wealth Advice with another personal finance hot take. Today's take will give you a bit more detail into fixed indexed annuities and why they should or should not occupy a space in your retirement plan. These annuities are often misunderstood by clients and advisors, usually because there's a particular experience stuck in their head. The sad part is that these misunderstandings keep them from considering products that can completely change their retirement income plan for the better. So here are 4 common misunderstandings that might be keeping you from a stress-free retirement. Pay attention to number 4. It is the key to a successful retirement income plan. Misunderstanding number 1. Stocks and bonds move in opposite directions. Many professional advisors tell you to put 60% of your portfolio in stocks and 40% into bonds, or some variation of that. The idea is that bonds will protect you when stocks fall. But we have seen years when that doesn't work. Your bond funds can lose value at the same exact time your stocks are crashing, and you end up losing money on both sides of the equation while still paying management fees. It's a double hit that most retirees can't afford. A fixed indexed annuity, or FIA for short, solves this problem. A fixed indexed annuity is not an investment in the stock market. It is a contract with an insurance company. The company pays you interest based on the performance of a specific index, like the S&P 500. If the index goes up, you get a portion of that gain. If the index goes down, you get 0. But here's the key: you never lose your principal. A fixed indexed annuity is not a way to get rich. It is a way to stay rich. If the market drops 20% tomorrow, your FIA value is exactly the same as yesterday. It is a floor for your retirement that bonds simply cannot provide. Misunderstanding number 2. I can't get to the money in my annuity. Many people shy away from annuities because they think their money is locked up without massive penalties. This fear causes people to keep too much of their money in low-yield money market accounts where inflation eats away their purchasing power every single month. You get the most value out of a fixed indexed annuity if you use it as a long-term investment. But the reality is that most modern FIAs have fairly generous liquidity features. Most contracts allow you to withdraw 10% of your account value every single year without any charges. Many contracts also have nursing home or terminal illness waivers. So if life throws you a major curveball, you can often access the entire balance penalty-free. At Advanced Wealth Advice, we only recommend annuities after creating an income and tax plan for you, and then only if the timing of when you need that money works well with a fixed indexed annuity. If you like the idea of never seeing a part of your portfolio go down, let's talk. You can book a strategy call through the link in the description to see if a FIA fits your goals. Misunderstanding number 3. I'm invested in the index. One of the biggest mistakes I see is people forgetting what they are getting. A fixed indexed annuity pays you interest based on the performance of an index, but you won't get that exact growth. Unfortunately, a lot of people have invested in FIA thinking they are in the index. Their advisor may have given them a full and correct explanation, but our mind likes shortcuts. We're in the index, and we don't take that thought any further. So when the annuity doesn't earn the same amount that the index grows, it's easy to believe it's not a good product. But you have to understand the participation and cap rates. The participation rate is the percentage of the index growth that you actually get to keep. Remember that we're calculating how much interest you will earn based on the S&P 500 growth. You're not invested in the index itself. If the S&P 500 goes up 10% and your participation rate is 60%, you earn 6% interest that year, not the full 10% that the index earned. There's also a cap rate, which is an absolute maximum rate that you will earn no matter how well the index does. And there are many variations. You can get 100% participation in the index, but your annual return will be capped fairly low at say 4 or 5%. Or you can get a low participation rate of 40 or 50% and have a higher cap rate of say 10 or 12%. I almost always look for uncapped strategies. Newer versions of FIAs also give you options for higher participation rates for longer periods. So you might get a 40% participation rate of the S&P 500 growth over 1 year, but you could get 80% if you measure the index growth over 5 years. At Advanced Wealth Advice, we show our clients various alternatives to find out where your comfort level is. And finally, misunderstanding number 4. I'll take my income from my portfolio when I need it. What is the worst time to sell an investment? Well, when it's gone down. The most destructive thing you can do to your portfolio? Sell because you have to, not because it's the best thing for you. Selling should always, always, always be on your terms. FIAs solve this through income riders. Instead of guessing how much you can take out, the insurance company guarantees a specific lifetime income amount that usually grows over time. This is a completely separate calculation from your actual cash value. Every annuity uses a different method to grow your guaranteed income, and it can get fairly complicated, so ask lots of questions. But it can be a great way to make sure you never run out of money, no matter how long you live. You get to create your own personal pension. If you need $50,000 a year to cover your basic expenses like housing, food, and healthcare when you retire, we set up the annuity to pay you exactly that at a minimum. This allows you to leave your other investments, like your brokerage account or Roth IRA, alone. When your must-have income is guaranteed for life, you don't have to worry about the ups and downs of the stock market. You can focus on what is important to you. Planning for retirement shouldn't feel like gambling with your life savings. If you want a clear look at how a fixed indexed annuity can guarantee your principal and future income, click the link in the description. Book a strategy call today to see the exact numbers for your situation and get a personalized path to a secure retirement. You can also visit our website at www.advancedwealthadvice.com to learn more about us. I'm glad you decided to check out our hot take videos. I hope that you finish each one feeling a little smarter than when you started. Thanks for watching and have a great day.